Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsati, and in Search for Yields, I take you through what all is happening in the fixed income markets, and other aspects of fixed income markets, including a lot of education material as well, which is useful for investors and financial advisors alike to help take the best investment decisions and also take the right investment decisions that could help their portfolios or their clients' portfolios if you're a financial advisor. And in today's search for yields topic, I'm going to talk about how to calculate the holding period returns in bonds. Now, coming to holding period returns, what is holding period returns? Holding period returns is very simply the returns that you get from holding an asset till it matures or till you sell it in the market. In an equity, it's very simple. All you have to do is take the price at which you buy the share and sell it, or sell it and take the price at which you sell. And depending on the number of time period you hold, you calculate the holding period return. But in a bond, it can be, or in a fixed income product, it can be different, especially if you're invested in a fixed income mutual fund and you have redeemed the fund after investing after a period of some time. How do you calculate the return? Normally, the NAV gives you the return, but how does the NAV work? So, in a bond, it's much more simple. All you need to do is see what is the price of the bond at which you purchase the bond, what is the interest received, and if you take the interest out of the price, then you get the holding period return. And just before that, if you're a financial advisor, the best place to look for bonds to invest for your clients is Sign Our Bonds Partner, where we help financial advisors take the best and the right investment decisions in fixed income for their clients, which is helping both the clients as well as the advisors. The partner portal gives you a lot of information, all the information that one requires on bonds, including our own proprietary risk score. Also lists out all the bonds available in the market for investments and takes advisors through pre-transaction, transaction, and post-transaction support. And the best part of INR bonds is that we enable investors to actually sell the bonds through a very easy interface, very easy and transparent interface. And investors who sell the bonds want to know how much they have earned. So I'm going to take you through how you have to calculate the holding period returns of the bond. So looking at the illustration here, taking bond A, which we have, whatever bond that we have put out here, assuming that the coupon, that is the interest payable every year on the bond, is 11.7%. And an investor or a financial advisor advises his clients or her clients to buy the bond in the secondary market at a price of 103 rupees. And after 1 year, this bond is maturing in, say, November 23. The purchase price was in February 22. And the investor wants to sell the bond for whatever reason, and after 1 year. So assuming that the interest rates have moved up over that period of time, and the investor in scenario 1 is able to sell the bond at a price of only rupees 101. And if you take what is the return the investor is getting here? So if you take the interest received, the investor for every rupees 100 invested will receive 11.7 rupees, because the interest payable is 11.7% on the face value of the bond, which is 100. And if you take the purchase price, which is 103, and the sale price, which is 101, the capital loss is rupees 2. So all the investor has to do is take the interest received, which is 11.7 rupees, deduct the capital loss, which is 2 rupees, and so after 1 year, the holding period return is 9.7%. Right? If you take out transaction costs and any other costs, then maybe slightly lesser. So similarly, if the investor sells it at, say, at a price of 101.50, then you have to deduct 11.7 rupees from 1 rupee 50 paisa, which is a loss from the purchase price of 103 rupees to sale price of 101.50. And in a 1 year period, the investor will get a capital gain, will get a holding period return of 11.7 rupees less 1 rupee 50 paisa. And in the third scenario, if the investor sells at 102 rupees, then the capital gains, the holding period returns will be 11.7 rupees less 1 rupee, which is the difference between purchase price of 103 and 102. And so with this, the holding period returns, despite the investor selling at lower price, given that the coupon rate is pretty high, and the investor still receives a very good holding period return. And if the investors had bought this bond in a 1 year period, when all the other products have given returns of 4%, the investor still gets a holding period return of 9.5% and above, even if the sale price is lower. So that's how you calculate the holding period returns. Obviously, we have taken a very simple example that the investor sells after 1 year. But if the investor sells in 6 months or in period of more than 1 year, then the returns get either compounded or annualized, depending on the when the investor sells the bonds. But the concept is same. So in a bond, it's very easy to calculate the holding period returns. All you need to do is to see how much of interest income investors getting, and what is the sale price or the maturity price of the bond. And then that's the holding period return for the investor. Thank you very much for listening in. And do not forget to download our app, QuickInvest Buy in Our Bonds, where investors who have checked the bonds available on offer there, the most information, transparency, and the best in-apps investment process, along with our proprietary risk score. And investors who have invested through QuickInvest have really benefited through very good holding period returns. And like I said, we help investors sell the bonds as well to get good holding period returns. And if you're not subscribed to our YouTube channel, please do so. Thank you very much.